The man to my side is George Noble. George is, by all counts, an investing legend. He was Peter Lynch's right-hand analyst, and George himself ran the #1 ranked mutual fund in the country at one point with 27.5% annualized returns. He's practically a household name in the institutional finance world. And George is really concerned, I'd say, about 7 specific things going on in today's stock market. We'll talk about those in a minute, as well as one money move George thinks you should make for 2026. So, George, welcome.
Thanks for having me. Good to see you.
So, George, we're here in the beautiful Hudson River Valley. For someone who is maybe not super familiar with your background, can you give the synopsis bio of George Noble?
So it's not my first rodeo, as they would say. I've been doing this since 1981, started my career at Fidelity, grew up there. As Ned Johnson used to say, never confuse brains with the bull market. The Dow Jones in August of 1981 was at 800.
It was a very fortuitous time to start investing.
Right place, right time. Work hard, smart, went to the right schools. But, when you start in the summer of 1981, timing is everything, as they say. And began as an analyst, was fortunate enough to be the auto analyst, actually, when Peter Lynch famously went to Detroit and visited Chrysler, Ford, and GM. I was the guy carrying his bag, learned a bit from him. And in 1984, Fidelity started their first international fund. Believe it or not, they didn't have an international stock fund at that point. I was the guy, and I had the good luck, bad luck, if you call it, it's a mixed blessing. In 1985, the first year I ran money, I had the #1 fund in the country. It was up 79%. And over the 6 years I ran money, I was up #2 fund in the country. And as you said, compounded over 27%. Subsequent to that, I had a couple of hedge funds, which did reasonably well. They're multi-billion-dollar hedge funds. First one I had to close for personal reasons, had a health issue in the family.
Mm-hmm.
And the second one, it's funny, the bear market didn't do me in. Since I tend to be a glass half empty kind of a guy, I actually did just fine, thank you very much, in 2008. As I recall, I think my fund was only down 1% when most were down 30, 40%.
Yeah, 40%.
But what got me was, believe it or not, most people smile when they hear this, I got bullish too early in 2009, and the first quarter was not kind to me. And I got to the second quarter, and I was like, you know what, I'm done. I was just burned out, and so I returned money to investors, and been running my own money since then. We had a foray with an ETF a couple years ago in 2022. We'll get to that later, which didn't do all that well. But aside from that, I've maintained an active presence in social media, as I know you're aware, and so I'm still very much involved in markets. I'm just not running a public vehicle right now.
So, George, we've known each other for a little bit by now, and one thing that I've noticed about you, at least with me, you're very humble about your mistakes, which I respect a lot. And yeah, starting a career when you did, that's a great bull market, but you don't get 27.5% annualized returns just by luck. So that's some skill right there, just as a plug for you. And I'll only segue that though, because you have some gut instincts. You have a sense of the market that I think very few investors have. You can talk about just about any investment. So if we were to step back now and look at today's stock market, we have stocks at or near all-time highs. We have corporate earnings that are pretty darn good so far, but we have rising unemployment. We have inflation that's kind of tamed, but not totally, not in the way the Fed would like, right? We have trade wars on the horizon. So in a way, probably more than any other market, at least that I've seen in my career, you've got a pretty good list of reasons to be bullish, and you've also got a pretty good list of reasons to be bearish. So from a 50,000-foot view, can you give the audience your overall take on today's market?
You laid it out extremely well. I'm reminded of the saying, the market's not the economy and the economy is not the market. I'm also reminded, and I know you've seen this graph before, James, you go back over 100 years of stock market history, and they annotate it and they say there's always a reason to be negative.
Yep.
All right. Okay. So usually betting on the end of the world is not a profitable strategy. I've done that more times than I care to admit.
Yeah. And the graph, just for maybe Cuban Missile Crisis or 9/11 or all these different things, you think, oh my gosh, the sky is falling, and
something.
For a year and a half, maybe 2 years, sometimes a little longer, it was bad, but then it always came back.
Right. But usually, whenever you have one of those episodes, markets sell off and prices are down. Despite the litany of risks that you just articulated, last time I checked, the market was kind of at an all-time high. Valuations were pretty darn high, especially in some of the speculative parts of the market.
Yep.
And I think, coming at a time as well when economy's not doing all that great. And I think one of the key things to focus on, you mentioned, is debt levels. And the debt excess we have right now, it's less in the private sector,
Hmm.
because if you look at private sector debt levels, are actually okay. It's more in the public sector. I mean, fiscal profligacy, $30 billion, trillion budget, accumulated deficit, $2 trillion budget deficit per year. And this has become a global thing, by the way. And so, this has all been fueled by more liquidity being created to sustain the debt creation, and the markets have been accommodating so far, and that was all well and good when, I guess, inflation was very low and there were buyers for this debt. But James, it's kind of hard to imagine. But as the saying goes in social media, I'm old enough to remember when. I mean, go back and look 4 or 5 years ago. All the debt that was being issued with coupon with negative interest rates, like, what were they thinking? All right. And so you're right here, right now, and you're like, okay, the 10 years at 4.10 or whatever it is today. As you said,
Hmm.
inflation, maybe the Fed, I read something great the other day, maybe the Fed thinks they're done with inflation, but inflation's not done with the Fed. And so, given the burgeoning debt levels and still sticky inflation, like, why would you lend money voluntarily to someone for 10 years at 4.1%, the US government? Given you wouldn't. And we could talk about yield curve control or financial repression or whatever, but I think bonds. I've been negative on bonds. I'm still negative on bonds, and we'll get to the risks later. But I think rising interest rates, particularly at the long end, is one of the key things I'd watch out for
I want to
2026.
double click on that in a second. But so a crude analogy might be that the party is going on, and this is weird, but maybe somebody's been spiking the punch bowl with amphetamines. And sooner or later, things could crash. In other words, yeah, market's at an all time high, but I might not want to just jump in.
I think that's a good way of putting it. And also, we'll get to precious metals and gold later. Keep in mind that we have this incredible financial asset inflation, and as tongue in cheek, I like to refer to the phenomenon whereby these prices are all measured in American pesos.
Hmm.
Okay, so but we're seeing the debasement trades become a very common
Yep. Yep.
topic of late, but that in turn is informing why gold is doing so well. But if you go through a thought experiment and just take the price of gold or gold miners, take the S&P and divide it by units of gold, you'll see that
Hmm.
prices are actually going down significantly.
Huh.
So it's sort of like it's the basement of money, basically. And so there's a sort of monopoly like element to this whole thing.
Yeah, it reminds me, during COVID, our central bank, as well as many others, pumped liquidity into the economy, thinking, okay, let's stimulate inflation, let's get things moving. And we had liquidity, but no inflation for a while.
Right.
What was happening? Well, we did have inflation. We had asset price inflation.
Correct.
That money was just going into stocks, just going into bonds, and it took a long time before it really went into the real economy. And when it did, yeah, we had 9% inflation, but
Right.
we still have that asset price inflation, you could argue, and that's causing the K-shapedness we've
Exactly.
seen in this economy writ large too.
Right. And so the market's full of opportunities. I mean, dispersion is one of the things we talk about a lot. Just one well-known FinTwit personality talks about. There's always a bull market somewhere, and my job
I
is
think
to
I
help
know
you
that.
find it. Okay. So precious metals specifically, and then the reflation trade more broadly, is, I think, it's been doing well, but more importantly, I think prospectively, I think will continue to do incredibly well. But conversely, those companies that are exposed to the unfortunate side of the K-shaped,
Mhm.
consumer discretionary, in particular, as an example, I think it's going to be a really difficult time. I think housing is still very challenged.
Yep.
So again, it's a market of stocks. It's a market of stocks.
So let me go back to a question, something you mentioned about the bond market, which is notoriously, or at least often, a bit smarter than the stock market. You mentioned long into the yield curve. You're bearish on bonds. For someone who is new to investing and hears that, can you just explain a little bit more what's going on and why you think it could be a concern? U.S. $38 trillion in debt, 2 trillion or nearly 2 trillion in overspending every year, which basically adds to that debt. And so, what does the bond market tell us from the long end?
So we're taping this morning on Wednesday. I believe the Fed is going
Yep.
to be opining this afternoon. And what will be interesting, and keep in mind, the Fed just controls the short end of the yield curve, not the long end of the yield curve.
Yep. And
So,
barely even that. It's the Fed fund rates technically, and the market can decide to bake that into the yield
the
curve or
Fed's
not.
always following the market. That's all
Yeah,
another
yeah,
thing.
yeah.
Which, by the way, things that trigger me, I think the excess. I know we're going all over the place. That's my nature. But things that trigger me, I mean, the inane amount of Fed talk, it's just a waste of time. At any rate, so what will be interesting, as the saying goes, is not the news, but the reaction to the news. Let's see how the long end of the bond market reacts to whatever the Fed decides to do. All right. And other times, normally when you have rates being cut, you would expect uh, long rates to come down.
Yeah.
But as you rightly point out, that has not been the case the last few years. And that's the market's way of saying, hey, you know what? Maybe in the short run, things aren't so bad, but looking out,
Yeah.
this is irresponsible policy. You probably were familiar with the phrase the bond market vigilantes. So I go back to what I just mentioned a minute ago, which is, would you lend money to someone who's piling up debt like this at 4.1% when inflation's 3? I think some of us think inflation's even higher, but let's just stay with that. You're not being compensated adequately for that. And as the debt piles up, so to speak, the credit worthiness of the borrower is going down. And just like, imagine, James, if you I went to the bank and your friendly banker would say, well, how much debt do you have? They'd be like, what? Your income's 5 trillion a year. You're spending 7 trillion a year. You have 38 trillion in on balance sheet debt. You add in all the entitlements, you're talking north of 100 trillion.
Yep.
How do these numbers work?
Okay. So the market says in the short to medium run, yeah, we think the U.S. can keep printing money, keep going. But when the long end goes up, just to unpack it, I guess, for the average listener or somebody's not familiar with the bond market, let's say, when the yield goes up, it means people are not paying as much for those bonds.
Correct.
Yield and price
Prime
moving
price goes
inversely.
down,
Saying, I'm a little worried once we get 20, 30 years out, maybe the U.S. isn't going to pay back or isn't going to pay me back with money that's worth as much.
Or it might be easy to see it through third person. If you look like an emerging market country, I don't know, Argentina, Turkey, where the currency is under pressure, and the only way to stop that, if they're running, if rates are too low, currency will continue to decline, inflation will continue to go up, and the bond market of those countries will continue to sell off. To stabilize them, they have to raise interest rates to make it clear to people they're good stewards of their currency.
Yep.
All right. Now you may say, well, gee, George, the dollar hasn't gone down that much. Yeah, it's gone down. I think this past year's down 8-9%, I think, on a trade weighted basis. So that's beginning. But what's more interesting to me, trying to figure out the dollar's going up against the euro, down against the euro, who the heck knows? As I mentioned earlier, all fiat currency has this problem. So it's the devaluation of fiat currency, all fiat currency against real assets. That's why scarce assets are doing well. Precious metals, interesting in my view. Some people prefer Bitcoin, but we haven't seen this before. So in a way, we're kind of, and then my friend Louis Gav from GavCat talks about, are we going Turkish? It's like, because when you have debt, too much debt, there's a couple ways you can get out of it. You can either default, have a hard default. Well, not going to happen with U.S. government debt. Or you can have a soft default. We'll pay you back. But as Alan Greenspan famously said a couple decades ago, I can assure you we'll be able to honor our entitlement commitments, but I cannot guarantee you what the value of that money will be that will pay you in. So
monopoly money,
which gets back to, it isn't even so much about making money; it's preserving your wealth in real terms.
Yeah.
That's a challenge which I've not seen in my career. So to a certain extent, we're in uncharted waters here, I think. And by the way, when this is really going to matter, nobody knows. I was all hot and bothered about the bond market going back to 2021, 2022. As recently as the first half of last year, you had the 10-year going to the high fours. Yields have been well behaved the last few months, be it fears of a slowdown, or we have the tariffs, they're on again, they're off again, whatever. But my central case is we're not going to get a recession next year. We'll talk about oil prices later. So if you have no recession, rising oil prices, the whole commodity complex has taken a light now. Okay. Unemployment, last time I checked, the economy's not doing so great. It's not doing terrible, but the labor market's still okay. So I could see a scenario where, the market forces rates up. So that's what I'd be concerned about.
Yep. And I'll just add, no fiat currency, to my recollection, has lasted more than 300 and 350
Whatever.
years. Yeah, so that's a big picture concern. But a lot of those concerns you mentioned about the U.S. economy are paralleled on a stock market level. In other
Yes.
words, debt is usually, we can have economics, I often say, is a social science. But when you look at crises, when you look at crashes, usually there's some kind of a credit problem
Correct.
that is the actual trigger for that. So just segueing now into the current market, where again, we got all-time highs or close to all-time highs, but we have some concerns around credit. The consumer is not very confident these days. That's 70% of the U.S. economy. Now, Americans are notorious for keeping spending even when they're not confident. That's one good or bad
Buy
thing.
now, pay later, James.
Yeah, exactly.
We have new ways.
But we got these. We talked about these 7 deadly sins, let's say. So maybe let's start with SpaceX, which is recently in the news for an IPO. I think you mentioned to me when we called last night, $30 billion. They're going to raise
At least
$30 billion on a $1.5 trillion valuation, which sounds astronomical. Now, ironically, that's a fitting term for SpaceX because that's the nature of the business. Would you be buying into the SpaceX IPO or many other things that are going public in today's market?
So, James, in preparation for this discussion, I had to look up a couple of numbers. 2025 estimated revenues. I didn't say profits. I said revenues for SpaceX, which is predominantly government contracts. You are sitting down, is $15 billion. So you're talking about at 1.5 trillion, 100 times revenue. Let's not concern ourselves with things like profits. Let's just talk about revenue.
So translate, if the company had no costs at all, it would have to operate for 100 years at that revenue rate to pay you back your initial investment.
Correct. And you're obviously you're borrowing page from Scott McNeely, the former Sun Micro CEO, who talked about how buying companies at 10 times revenues is insanity. Well, I present you 100 times revenues. And by the way, we're not talking about some small cap. We're talking about something which is, if they get this, is at 1.5 trillion. Okay. So that's SpaceX.
No, SpaceX would say if they were here, hey, that's not going to be our revenue forever. It's going to grow, but it would have to grow a whole lot, and they're going to have a lot of profit to even remotely justify that value.
Right. And one of the problems that you have with markets nowadays, people get so caught up in the narrative. It's, what about price? Is it all in the price already? I could go on forever about that. Okay. But if I said to you, we're already in La La Land on 100 times sales. Well, what's the between 10 times sales, 100 times sales, 1,000 times sales? I mean, no one's paying attention to,
they're not buying based on numbers.
No. And was it Warren Buffett or Charlie Munger? I can't remember. Price is what you pay, value is what you get. Okay. So they want to come public at 100 times revenues. OpenAI, which you and I have discussed, I think is talking about $1 trillion valuation, if I'm not mistaken. And they're annualizing right now at about 15 billion. Wait for it. Again, in revenues. Okay. With losses as far as the eye can see. You and I were chuckling over a graph the other day showing the cumulative losses that they're likely to rack up before coming public. And it's just staggering. And so going back to your asking before.
And that graph, it showed Amazon, and we'll try to show it on the screen if we can. Amazon, a bunch of other IPOs that had lost, comparatively small amounts of money prior to their IPO. Then you have OpenAI, which is just a gigantic money pit.
Right. And so in the case of SpaceX, case of OpenAI, it's not clear what the path to profitability is. I mean, we can argue about what the valuation should be, but this has really changed the nature, I think, of IPOs. You and I have talked a lot about SPACs. Go back, SPACs is nothing new under the sun. They've been around forever, but we saw in 21, 22, this glut of SPACs. The investing public, unfortunately, they got an education. They always do. It's a question of whether you read about it in a book or by experience. And that was a real debacle. Now you see, by the way, SPACs coming back again. I think Chamath was talking about a SPAC. And there was one I have to mention, just came out this last few days. ProCap Financial. It's a Bitcoin treasury company. Don't push me on the numbers. In fact, not all the numbers are even publicly available. But what I can tell you is this Bitcoin treasury company. So the business model is just going to buy Bitcoins. Fine. We can argue about Bitcoin. It's a whole separate discussion. But you subscribe to this SPAC. I think it was at $10 or $10.15. They de-SPAC'd within the last week. Before we started taping, $3.50. So the thing went from 10 to 350 in the course of just a few days because of the de-SPAC. So people are chasing narratives. They're not paying attention to valuation. I want to be charitable, but let's put it in the positive way. I think people would benefit a lot from more financial education around these things. I'll mention another name you and I have spoken about. Everybody knows. We're all tired of getting ripped off by ticket scalpers and ticket resellers. StubHub, which I'm sure you know, they came public earlier this year. Like the multiple EBITDA, don't get me EBITDA. I shouldn't even say that, but they had no profits, so I had to talk about EBITDA. Okay. And
probably had no EBIT, or maybe not. So you have to keep moving up the income statement.
Yeah, exactly. Exactly. So, and I think it came in at 23 and a half. And last I looked, it was like 11 or 12. And it's just because they can get the issue done, they can get the offering away, doesn't mean they should. So you look at StubHub and okay, fine. So they were able to get the deal away. But why should they do a deal like that other than just benefiting the management of the company? It's like, how's the public interest being served by that? So I think if you look at IPOs, the valuations, another trick that they play too is with the floats. They make the floats really tight, really small. So unless you're in there on day one, buying day 2 or 3 or 4, usually doesn't work out so well. And I'm reminded, Peter Lynch used to have this saying, what does IPO really stand for? It's probably overpriced. So, but again, it's narrative, it's buzz. I get it. But one other thing which I should mention, the number of years that these companies now are staying private before they become public. You've seen the emergence of a lot of these unicorns, and they don't need the private capital. So a lot of that growth that you might have participated in had they gone through an IPO instead accrues to the private investors. And so by the time they come public, a lot of the juice is already taken off the table. It's obviously not the case in SpaceX or OpenAI, but it's just a multitude of sins here.
And that brings us to another question I have. And by the way, these things are happening, you could argue, because they can. There have been markets where you could never dream of taking a company public at 100x revenue. Market just wouldn't pay for it. Now they will. But you mentioned IPOs. You mentioned companies waiting longer to go public. It's costly to go public, not just as a one-off every year. A couple $1 million is the average burden of being public. And so there's an argument that, and we used to have 8,000 publicly traded companies. I think now there's like 4,000. They're going down. People have pounced on that. Places like Robinhood, I know Republic.com is a crowdfunding platform. There's a few others. There's this like democratization of finance theme, and it's a narrative. And I think there's some truth to it on each side. And that, hey, if you're the average guy, rather than wait until something goes public at a SpaceX valuation, you can now use your 401k. You can now use your Robinhood account to buy some private company, or maybe not even the company itself. There are these quasi-derivative instruments that give you access to the delta in price between now and the IPO price. Exactly. They don't like to call it a derivative, but it's kind of a derivative. My question is that good? Is that good for the little guy now, putting people on an equal level playing field? Or is it more that maybe some of the smart money is sitting in these private issues and wants liquidity, and they can't dump it on the institutionals as much as they want? So, hey, guess what? Let's cultivate some of these suckers through the private market, these little guys, and we'll sell them these hot things with very low information. Private market is the Wild West, information-wise, compared to public markets.
You hit the nail on the head. The illiquidity is something that I think people overlook, and it's fine when also, as you said, the drinks are flowing and the party's going. But the disclosure or lack of disclosure, I mean, I don't want to sound elitist about this, but there are good reasons why there are restrictions have been restrictions historically on private investments, because it requires a certain level of sophistication to appreciate fully the risks that are entailed. In the same way, I mean, just because you watch a YouTube, podcast or something and it sounds great, I'm going to buy some of that. James, I kind of think if you or I were sitting around and watching a YouTube of some doctor conduct open heart surgery, we wouldn't say, "Oh yeah, I got this. I see how they do this." There's a reason. There's a reason for it. And so,
So just because your favorite influencer is buying some
yeah,
IPO or private
yeah,
company, you don't, yeah.
whatever. And I think short shrift is made of all these safeguards.
Hmm.
And I don't want this to come across as a political statement. It goes on both sides of the aisle. But the environment has been such for a large number of years, and it's getting worse now, where there's not only no enforcement of a lot of the existing rules, but there's a relaxation. And I think it's problematic. And my fear is this is going to continue until the repercussions are
Yep.
heard. You know, allied to that, you have the emergence of the betting markets, prediction markets.
Yep. Yep.
Where's the line between that and equities and derivatives? I mean, it's
Exactly. And it's scary because frankly, gambling is always going to be more fun than investing, right? So you got these young people that, oh, cool, I'm gonna make some money, but you're missing something. In the old days, when you put money into a company, either at the IPO or at a secondary offering, you're doing a service. You're finding and rewarding good companies, and
correct.
you're depriving bad companies of capital. And over time, that makes an economy healthy. When you have a derivative side bet between two people on, what a company's going to do, or how many times Trump's going to mention a certain word in the next speech, or these random things that people are betting on, you kind of take that benefit out of the economy. One could argue,
I-
not as healthy a capital market.
Correct. I mean, you're not providing risk capital to help
Yep.
companies grow their business.
So just to recap, just IPOs, they're not inherently evil, but very likely to be overpriced. And probably some of these issuers are taking advantage of a frothy market to bring IPOs to market. In terms of the democratization of finance, uh, that's a lot of fluff, it sounds like, in your book.
Read the
Yeah.
fine print.
Yeah. And the next thing I want to segue into is this notion you've mentioned that there's a difference between the stock and the product. These are all connected themes if you haven't caught on already, but somebody might say, oh, cool. I like Tesla. And your former boss, by the way, Peter Lynch, he's always said, buy what you know and love. And so there is a rightful connection. Say, hey, I've used this service. I've used this company for a long time. I like it. It's probably going to persist. If I like it, other people will too, blah, blah, blah. Right. So, George, my question, how do you separate buying what you know and love with thinking, I like my Tesla. I like Elon. Tesla's awesome. I'm not going to look at the financials. I'm just going to buy Tesla because I'm in this tribe.
So it's a great point you raised. Peter Lynch would famously talk about know the product, and in that respect, in those cases, the individual investor would have an advantage. He would joke about his wife. She's now since deceased, Caroline. She had a black belt in shopping, so he would ask her, like, go to the mall and
Yeah.
what's selling. It's Lululemon or whatever it is, all right? But when you think about that, the focus, it starts with it's the product.
Yeah.
I like the leggings, I like the car, whatever. Okay. Um, I find so much of the discourse that goes on nowadays, it's all about the price of stock.
Mhm.
And, I've gotten to more than my fair share of dust ups on X. And I find whenever someone is pretty much exclusively just talking about the price of the stock and not the product and not the fundamentals and not the valuation, that kind of tells you all you need to know. All right. And I find it worrisome that in so many cases, companies now are increasingly focused just on the stock price. Now, you may say,
Mhm.
well, look, George, at the end of the day, it's essentially without a difference. They're making higher sales and earnings because eventually the stock price will go up. But is it based on fluff or is it based on substance? So I know we'll talk about Tesla later, but when you look at a stock compensation plan, which is directed not at generating revenues of X or profits of Y, but instead on the stock price hitting certain levels, triggers, or EBITDA,
Yeah.
which is not equal to net income hitting certain levels. You really, and look, I personally don't think it's really going to matter. I don't think he's ever going to make his pay package. It's neither here nor there. But that's emblematic of how the incentives are being rearranged. And I think it was Charlie Munger who always would talk about, you show
Show
me
me
the incentives, I'll show
I'll
you
show you
the
the
outcome,
outcome.
right?
Yeah.
And so it's become a great game. Like, let's see how we can legally get the stock price up, maybe by forgetting to mention certain things or putting enough lipstick on the pig, so to speak. And so that when you look at, like, for instance, accounting, we've talked about EBITDA a few times now. You can go on and on about EBITDA, or you can just talk about top line. But hey, in the early days, you look at Tesla or a lot of other companies, if you're selling dollar bills for 80 cents, you and I can make if that's where it's like watch the red card, not the black. If that's what you're telling
Yep.
everyone to watch, fine. But eventually that model has to scale into something where you generate enough gross profits where you can overcome your fixed expenses. But the whole game has been set up in a way where it's increasingly designed, I think, to separate separate a fool from his capital or whatever. So yeah.
So let me ask you this, George, because on the surface, it sounds good to align managers of a company with shareholders by rewarding them with whether it's stock-based compensation or compensation targets tied to stock price. But that's known in deeper circles as being kind of a little bit icky. It would seem like because for as one example, a manager who's about to retire may say, "Oh, heck with this! I'm going to massively cut R&D budget. I'm going to cut investing expense on new projects and juice my profit margins. The market's going to like it." uh, I'm going to retire in a year or two, make my payday. The next guy is going to get stuck with this huge investment burden, right? Because I'm not doing enough. That's one version. But in terms of the story versus the stock, you could argue like Elon Musk, for example, he's set to make potentially $1 trillion if a whole bunch of things go right,
Right.
which seems a bunch of, I forgot how many humanoid robots, and they don't have any they're selling, how many autonomous cars, and they have just 100 or so in production. It would seem almost impossible to reach. So I guess my question is, do you think that motivates not just fans of the stocks, but the managers themselves to tell these stories, to
100%.
capture the market when it's just not economic reality?
100%. 100%. And so it results in a misallocation of capital. And this is a much deeper conversation, and I'm not sure I have the answers. But I think long term, I don't think it's in society's best interest or our economy's best interest because we're just investing
Yeah.
in the wrong places as a result. No, it's a real problem. It's a real problem, in my opinion. And by the way, on the stock based compensation, and we've talked a fair bit about that offline. People gets back to the gap versus the non-gap and price versus
Yep.
truth.
Yep.
Price versus value. So the companies now increasingly they'll have you focus just on gap adjusted EBITDA. And they'll say, in the most famously, stock based compensation, they'll want you to ignore that. All right. But just think about it for a second. If you're running a tech company and instead of paying an engineer $200,000, you can pay him cash, you can pay him $100,000, and you're going to make up the difference in stock options. That's a real expense. I mean, you save yourself $100,000. So for those who would say, oh, you need to back out the stock-based compensation. I'm like, no, that's just not theoretically, it's incorrect. And in fact, it's even worse than that because in many cases, you'll have companies, I've seen this happen time and time again, companies, the share count starts to go up in a rather prodigious fashion, which is something everyone should look at too, because
Hmm. Hmm.
you look at the shares outstanding of Tesla, just to pick on them, it just keeps going up and up and up. But some companies, in order to keep the share count down, to offset the dilution that comes from
Yep.
stock-based compensation, they turn around and they have to go into the market to buy back stock. So the real cost of that is far more than the imputed cost of the options, the Black-Scholes model, when they put on that. So this whole stock-based compensation thing is just totally out of hand. And then when you think about it, finally, in the end, you think, what's the company worth? Well, if you said, okay, well, they made all this non-GAAP earnings over all these years, but then you go look after a number of years, well, what's the company actually worth? Well, a large portion that got paid out, like the shareholders' equity, is not equal to what you thought it was
Yep. Yep.
because all the money got paid out because of the options or whatever. So it's a complete three-card Monte game.
Totally. And we both remember 20 something years ago, the idea of putting stock options as an expense or not, that was very much contested. Warren Buffett was in favor of that. And it sounds like you're talking about people who might back that out of free cash flow analysis, thinking, oh, stock-based compensation, that's not a cash outlay. Therefore, I'm going to adjust my free cash flow. But guess what? If you give a manager stock options and he or she can buy a stock for, let's pretend it's $60 a share, when the stock is trading at $100 per share, you're diluting
Yep.
your investors by $40 per
It's coming
share.
right out of your pocket.
Yeah.
Yep.
Exactly. So whether that's coming out of the company's coffer literally as an expense or not, is very much a cost that should be taken out of free cash.
Again, don't look over here, look over there.
Exactly right. So a lot of sleight of hand. I don't know if we want to get too much into names, but we mentioned, I think, Peloton in some conversations, or Snowflake. How do you think Buffett? I think Berkshire owns Snowflake, right?
I'm not up on Snowflake so much. He may, because his successor, I think, is more.
I'm sure it was one of the.
But what I will say on Snowflake, yeah, actually, I happened to see this the other day. If you actually look, aside from the first day pop,
yeah,
I think Snowflake is like down. You've actually lost money in Snowflake, or it hasn't done anything for 6 years, however long it's been public.
Yep.
Which, by the way, reminds me of another observation we didn't touch on earlier. You look at the empirical data of returns from IPOs, investment returns. No, it's a waste. It's a bad use of time.
Isn't it something like 70 or 80% of IPOs are underwater after the first?
Yeah, the first day.
It's some majority.
Yeah, and you're not going to get any real supply the first day, so it doesn't count. So you should measure from the second day or fifth day or whatever. It's just a waste of time.
So I'm gonna segue into one of the other points you mentioned, which is a difference between price and value.
Yeah.
And obviously this connects to narrative, this connects to even stock-based compensation, almost IPOs, almost everything we've been talking about today. I want to hear you explain, but I want to make the counter case first, which is there are people who say price is truth. Usually the chartist people, price is truth, and if the market's paying this for this, and you know what, like, I think they're right in the short run, in the sense that if somebody will pay me whatever for SpaceX tomorrow, like, that's real. But then there's another argument. You look at a long-term chart of stock price and earnings, and over like 100 years, there's a very strong case for stocks following earnings. And so we get too far away, maybe we're going to have mean reversion. But the hard part is nobody knows if that mean reversion is going to happen in 2 months and 2 years or some other time. So, like, where do you think we're at in terms of the craziness level of the market? And do you have any predictions as far as when things might come back? In other words, somebody might say, George, you're negative on Tesla, but you've been wrong for a long time on Tesla. I'm just giving up on this.
Guilty as charged.
On this, mean reversion to fundamentals thing.
So what's the difference between price and value? As you said, price is a number at which two parties are willing to transact at that given point in time. It doesn't matter if that's value. It could be that, I don't know, you and your wife are out looking for a new home, and your wife, in a moment of, she falls in love with someplace, and she's willing to bid 30% over everybody else just to get the house. Okay. That doesn't mean, is that the value? Well, that's the price it transacted at. Okay. So you think about what's the value? Value could be, you could have a cash flow producing asset, and you put some capitalization rate on that. You could have an asset which is being auctioned off, and what's the highest bidder willing to pay for that? You could have a distressed seller in liquidation, say in the throes of the GFC. It's like, I have to get rid of some assets. I know I'm selling at a depressed price, but that's the price, necessarily the value, but I need the cash. Everyone's got a different motivation when they're transacting. And so for the folks that are dealing with a lot of the retail favorites, well, for them, the objective is, number go up. Okay. Price becomes the thing. Okay.
Yep.
They don't care about all these other things. All right. And Bitcoin we'll talk about later, but similar argument. All right. And so I won't mention names to be nice. You mentioned that calling cry, price is truth. No, it is not. It's one of the most idiotic things I've ever heard on the street. When will this revert back to maybe what more historical norms? It may take a bear market. It may take people getting burned. Maybe at the market overall going down so much, but getting burned in really speculative nonsense. So if you're buying, and I'll name names, Oklo, for instance, okay, which is a 15
nuclear power startup.
They're not going to have any revenues for like 10 years or whatever. It's $15 billion market cap. It's hilarious. If anyone's interested, go look up the CEO of the company. It was mentioned in a recent article I read. He was thought to be the dumbest guy in his class at MIT. He never did his work. You just read the whole massive insider selling. All right. It's just the complete hot air bubble. All right. Oklo was 5 and by the way, it also came into existence via a SPAC,
Mhm.
was 5 in October of 24. It went from 5, more or less in this straight line, I think, to 180.
That's a
Okay.
big jump.
Okay. I think
Yeah.
it's about 100 right now. All right. It's got like a $15 billion market cap. All right. So if price is truth, truth was moving
Just
around.
change that often. Yeah,
Yeah.
yeah, yeah, yeah.
Explain that to me again. Okay. So again, imagine you're an investment banker, or you're trying to, let me go to investment banker. You're trying to figure out what is an asset, what's a, what you're going to buy a used car, or a
Mhm.
house, or whatever. You compare it to comparables. You look to see how much work it needs. You look at the historical pattern of it. Okay, they're all, and so in each method you use, whether it's liquidation value, highest bidder, cash flow, whatever,
Mhm.
there's not going to be one number,
Yep.
but you'll come up with a different way of valuing the thing, and you can say, okay, on a good day it's worth this, on a bad day it's worth that. All right, so it's in this range. Okay, it's not what some crazy retail investor is willing to pay on that particular day. Or, gee, I bought the house I didn't really want to, but my wife insisted. I knew I was making a mistake when I did it. Okay. So price is not
And
truth.
not all wives are
Sorry. It could be,
reckless
it
like
could, it
that. They
could be you.
could be me.
It
Yeah,
could be
yeah,
you.
yeah,
It could be
yeah,
you. Okay. But you get the point.
yeah, yeah. But so if we look at Oklo, if we look at Open Doors, another company that you had at least a mini vendetta against, for I guess a similar in spirit reason, but just taking OpenDoor an example, and it's not just OpenDoor. We saw a similar thing with GameStop, with AMC, with
Yep.
basically every meme stock. It's some version of, you got this tribe of retail investors who are buying it for, in the case of GameStop, for example, they kind of wanted to stick it to. I mean, this was a
Stick it to
dying.
the street.
Stick it
Yeah.
to the street.
Stick it
Stick
to
it to
the
the big
shores.
guy, the
Right.
powers that
Right.
be.
Right.
This was almost a left for dead video rental company. AMC, dying movie theaters. These usually have some crappy dying business. It's not that great. If not dying, it's not
Right.
living well, at least. But like, just for kind of the vibe of I don't know, rooting for the little guy, or the underdog. These retail investors buy these stocks. My question is, you get enough of them buying it for, regardless of what you think of the reason, its intelligence, if they're doing it for that reason, don't you get an economic reality that sustains itself to some degree for some period of time?
For only for so long. Again, it's I think it's Warren Buffett. I sort of keep quoting all these people, but as a sidebar, I consider my role kind of in the investment continuum. I learned from a lot of folks who were absolutely brilliant, and have, try to pass down a lot of what I learned from them. There's
Hmm.
wisdom in a lot of these eternal truths. And so Warren Buffett, I think he famously said, "What in the short run, the market's a popularity
Voting machine,
contest.
yeah.
Voting
Long
machine.
run, it's
Long
a
run,
weighing
it's a
machine. Yep.
weighing mechanism." Okay, so we have this bid-ask spread between the two. So let's go to Open Door. And so what happens is, yes, it can create its own reality. There is a sort of reflexive nature to this whole thing. All right. So as an example, Open Door, they had issued a convertible bond earlier this year. This is
Hmm.
this is a
Hmm.
great story, actually. They issued a convert. The stock was in the toilet. The thing, it came public through a SPAC years ago, whatever. It went from like 40 down to 50 cents. It was like 50 cents in July, I
This is
think.
like a real estate matching company
It's
kind of
it's
sort
it's
of.
an iBuyer. It's a house
Yeah,
flipping.
iBuyer. They
It's a
flip your
house.
house
Okay,
digitally.
okay. But
Yeah.
here's the thing: they were really in a tough way in late spring, and they issued a convertible bond. I think it was a couple $100 million, 7% coupon. Check this out. Stock was like, it was like 80 cents or something like that,
Hmm.
and it converted at $1.50, I believe. Roughly, I got the
Hmm.
numbers right.
Hmm.
So I figured, all right, stock's 80 cents, converts at $1.50. It's never going to get to $1.50. So what the heck?
Yeah, it's almost a double.
Okay, we
Yeah.
can get. How could that? It's not going to double, right?
Yeah. Yeah.
And we can get money at 7%. Well, okay, if you're as badly situated as they are, that's not a bad deal. Try getting a loan from the bank for that. So they go, check this out. So Eric Jackson comes along, it becomes a meme stock, right? He was just throwing stuff against the wall, most speculative stuff you possibly could find. And to your point, took on a life of its own. The next thing you know, Open Door goes from 50 cents to $10. 10. It's now 7. Now talk about the economic reality. So all of a sudden, this $200 million convert they have out there, all right, and having to pay 7% interest.
They can pay $1.50 and get.
Yeah. So I think the terms were if it got to like $2 for more than 30 days or 205 for 30 days, the holders could convert or whatever. And so here it is, the money they borrowed because the stock price went up. All of a sudden, they're able to get rid of the debt. Okay, now coming back to the fine print and democratization of finance, it was stunning. The debt, all right, the converts were so far on the money, they had to wind up issuing, I want to say, like 140 million shares. I'd say 200, a huge stock issue. All right.
Yeah.
So it's great the debt went away, but the shares outstanding went up like an unbelievable amount. All right. But most of the people that own the stock had absolutely no clue.
Idea.
Not only did they not care, they didn't even know. All right. So yes, there is this reflexive feedback loop between financial markets and the real economy. All right. And it's not always positive. And so in the case of open, we'll go back to value versus price again.
But on this open door, so normally weird things like that self-correct. There's enough smart money that may say,
Correct.
hey, let me short this stock. But
Correct.
Is it hard to get to borrow? Like it's just not enough liquidity? Why is that not self-correcting?
The borrow is not a problem. I think it's a low enough price stock at $7. It's achieved meme status.
Yep.
And so, people start running around the story. Oh, we're going to democratize finance. James, it's a real crime how expensive owning a home is. We're going to make housing more affordable. Of course, you before any company.
It sounds like a good story.
Okay. And you're going to be able to click of the button. You're going to be able to buy your house online. And not only that, you could be able to get title insurance and mortgage. And everyone hates, you hate real estate agents too, don't you? Okay. So why do we pay them 5% commissions, right? So the story is great. All right. But then when you get right down to it, you're like, well, okay, so let's try to put some napkin math together and see how this makes any sense. And just for those watching this, OpenDoor today at 7 has roughly an $8 billion enterprise value.
Mm-hmm.
Revenues, this is another scam you're going to love. So some of the promoters of the stock were saying, well, gee, OpenDoor is only selling on 1.5 times sales or whatever. And things like Zillow and others are selling at 5 times sales. Only one slight problem with that. Zillow just reports in their numbers, or if you look at, say, just real estate brokerage companies like Compass, they only report the commission portion of the transaction. So if you sell a house for $500,000, say they're charging 4% commission, they're showing $20,000. Okay.
Yeah.
OpenDoor, and this is not, and people say, well, it's not illegal. It's not a question of being legal or illegal. We're just trying to use common sense to equalize. OpenDoor, in that example, is selling a $500,000 house. They're not reporting just 20,000.
They're recognizing the
whole 500,000.
caboodle.
Okay.
Yeah.
It'd be like you buy you go back to StubHub. We're talking before about a ticket broker. Should StubHub just report the commission they're making, as outrageous as they are, the 10 or 20%, 20%, I hate to say it, or the whole value of the ticket? Okay. So it's not even, look, it's one thing if you and I disagree about the valuation of the stock, but this is like financial malpractice, analytical malpractice of the highest order. They're comparing apples with oranges, right? So coming back to OpenDoor, you have a company.
And you think OpenDoor is aware that they know people are valuing them on a price to sales multiple?
Yeah, they're not.
You could say, well, guess what? That stuff comes out in the expenses.
Yeah. They're not doing anything illegal, okay? And for that matter, those who are pumping the stock on that basis aren't doing anything illegal, okay? But either they're just completely financially illiterate, which I think is the case, or they're being a bit disingenuous. Take your choice. But at the end of the day, forget about
catering to those who are.
Yeah, because okay, so because again, we want to make housing more affordable.
Yeah.
Don't bother with these details, okay? So if you have a company like OpenDoor, which has an $8 billion enterprise value, and their total revenue line is on the order of annualized only be 200 million in the fourth quarter, it was 400 million for the last year. Let's say it's 300 million. Okay, that's that's the margin they make on flipping. They make like a 7 or 8% margin on flipping. Well, think about it for a second. If you have $8 billion enterprise value and you have 300 million in net revenues to you, okay, and you got expenses and all this other stuff that go along with that. All right. You say, okay, well, $8 billion value. I'm only taking 300 million in revenues. How much is going to be left for profits? I mean, I don't know, 50 million. I mean, they've lost money, by the way, every single year since inception. Okay. Which is another canard, by the way. Peter always say, study a company's record. And, but then the ones who are all about number go up, they'll say, oh, that's backward looking. It's about the future. You don't get it, old man. Okay. Yeah. But the past does tell you something about the future. Anyway, the point I want to make is, coming back to OpenDoor, if you have 300 million in revenues, you said, okay, well, what's going to be left over for profits? 50 million? They should be lucky to make 50 million. They've lost money every single year. 50 million, but let's get an $8 billion market value. That's 160 times earnings. So the problem I have with OpenDoor, even people say, well, you know, they're going from moving from an asset heavy model to more of a service model. They're still fundamentally a low margin business, very competitive.
Unproven business model, it sounds
like. A new model, okay?
Yeah.
And the problem is when you're starting out with an $8 billion value and your revenues are only, say, 3 million to start.
Big shoes to fill.
Yeah. And so, you know, it reminds me way back in the day, Walter Deemer, who is retired now, was formerly the technician at Putnam Investments. Prior to that, he worked with Bob Farrell at Merrill Lynch. He would tell the story in, I guess it was in the 70s, McDonald's was a great go-go stock. And it had just gone up incredibly. But this gets to value versus price now. And so it was a go-go stock, a glamour stock, and people were fawning over the company to buy more shares. And he was negative on the stock because he's like, it's already in the price. I mean, it's already discounted the next decade of growth. All right. And so eventually, over time, you know, McDonald's went nowhere for years. And finally, I think it was 81 or 82, he turned bullish on McDonald's, just the time where people were just like, the heck with this, blah, 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 blah. Okay. And so I think with a lot of these, so it's not that these companies won't be successful. It's what's built into expectations, what's built into the price. And coming back to the outset of our conversation, things that bother me, the future value, the value that so many companies, their stock market value depends upon the future. I mean, it always depends on the future, but how much is not resting on what they're presently generating versus what they might.
And how it sounds like very distant
and very distant
future.
And then people say, well, you know, I bet you were negative on Amazon, you know, in 1999, right? But
were you?
I've never actually
didn't have a view on it.
Didn't have a view on it. I didn't know what it was. All right. But you know, the thing about Amazon, do keep in mind, I think Amazon, I don't have the numbers exactly, but I know you're aware of this. Amazon along the way went down 90%. I think it went from like
94%.
Yeah, it went from like 110 to like 9 or whatever it was. And so I can imagine whoever was bullish on Amazon 110, and by the way, it's wherever it is now, it's split so many times. Whoever was bullish on Amazon 110, that somewhere along the way as the elevator was ascending to 9, like the courage of your convictions might be tested.
Yeah.
All right. And so there's that. And then it's also a question of time horizon, right? And also Amazon's changed its business model. I mean, there was no AWS, you know, way back when. So there's just people are, you spoke before about people, you know, wanting to more of a get rich quick type of phenomenon. They want to speculate, which is fine. I'm totally for speculation, but let's not confuse speculation with or gambling with, you know, considered serious investing. These are two totally different things. The sort of degen culture, if you will, has been in an ascendancy.
All right, so George, we're talking about price and value, stores of value versus not. You know, what holds weight at the end of the day. I want to ask you briefly about gold versus Bitcoin, because I can see people saying, hey, yikes, scary environment. I want to put my money in something that's going to store value. So maybe one of these two. Do you see a difference? And if so, what is that difference?
For a huge difference. And first I have to qualify myself or unqualify myself. So Bitcoin, I was publicly very bearish on Bitcoin in 21, 22, and that worked out pretty well. You'll chuckle. I had guys, I didn't know what planet I was on. I remember going to a Bitcoin conference.
So you were a bear, but you went to the conference.
They invited me.
Yeah. Oh,
they invited me.
Okay.
I had two guys. Bitcoin was
brave. Yeah.
Two guys. Bitcoin was 35,000. and they each bet me a steak dinner. This was like in the summer of 21 or 22. They each 22, I think. They each bet me a steak dinner that Bitcoin would go to 100,000 by the end of the year. I was like, okay. So I never collected on the dinner, but whatever. So I looked like a genius. And then I think Bitcoin went from 35 down to like, I don't know, 17. Next stop was 130, wherever the peak was.
Yep.
So this gets back to, we're talking before about price versus value. Okay. Store of value. Stores of value shouldn't be flying all over the place like this. Bitcoin, I don't have a position. It's the first thing I'll say. I'm not long, I'm not short. But as I look at it, a few things come to mind. I mean, it's sometimes the story's always changing. Sometimes it's a store of value. Sometimes it's digital gold. Sometimes it trades as like a speculative asset.
Sometimes it's a currency, a means of exchange.
Yeah, exactly. Okay. So yeah, there are many ways you can look at Bitcoin. But I do have a real problem with the store of value argument, and that's because Bitcoin's been around, I think, since 2011.
Yeah, something like that.
Gold has been around for thousands of years. Gold has proven its metal. Okay. I forget the old saw, James, about, you always, an ounce of gold, you always could buy a good men's suit or something like that. Well, now you can buy a really good men's suit with it. But that's battle tested. Just because some guys write a bunch of code and it's been around for 14 years doesn't mean it's a store of value. There's a certain, and I'll say it about gold too. I mean, people's moods, fashions come and go. Like, okay, I think the world's come down. I'll buy gold. I need an insurance policy. Like, everything's good. Why would I buy an insurance policy? So, with Bitcoin, same thing. The story changes, goes all over the place. What I think is interesting about Bitcoin, a few things. One, it gives me pause. I have no position, but it's the things that are less talked about. One, tech has done really well this year. Gold's done really well this year. Bitcoin, not so much. Depending on the day of the week, it's up a little bit year to date, down a little bit year to date, but like, what's with that? Two, we were talking before about price and fundamentals. I find when I get into dust-ups with others on X about Bitcoin, it inevitably and almost exclusively always comes down to price. That's all they can talk about. That's the story. It's price. Okay. And I mean, could you imagine going into a space or having a discussion? I don't know. We're going to talk tech stocks, let's say, or energy stocks. And all we're going to do is discuss price. We're just going to discuss the price of
single variable.
It's
single
price.
Single factor,
okay.
Yeah.
Like, you'd be like, this is wacko. Like, what? Okay. But that's what these guys do. And I totally get that in a world where, we keep devaluing fiat currency, Bitcoin may do well as a store of value. But for me, I don't want to mess around with that when I got gold and silver instead. Like, I just find, okay, then you want to get into stories like, well, quantum computing can make the whole thing end in a few years, so on and so forth. Let's be on my pay grade. You don't even have to go there. Okay. I just think, to me, it's uninteresting. And the other thing I would say about Bitcoin as well is the changing volatility. The institutionalization of Bitcoin, while it was long heralded as a desirable event and, go mainstream, and Fidelity and BlackRock and JP Morgan was gonna buy it, there's a downside to that. And now that it's in the throes of being institutionalized, we have bigger money involved in it. It's dampening the volatility. So the implied volatility in Bitcoin is coming down. Now, you might say, well, that's a good thing. Yes or no, depends on who you're talking about. For the DJing crowd that want to go to the track, it's like, wait, we want 80 vol.
They don't want it to be gentrified.
Okay. So they don't want that, right? And then you throw on top of that the rise of alternative methods of incinerating your capital, the prediction markets, the betting markets. Okay. So, like, why do I go into Bitcoin, which has relatively depressed vol, when you and I can bet how many points Steph Curry is going to score in the third quarter tonight of the Golden State Warriors game? So I think it's losing its shine a little bit in that respect. So that doesn't mean to say that I think it's going to go down, By the way, I have no position.
Mhm.
I think the risk, I think the risk is skewed to the downside now, because one thing you're starting to see as well, this is all very recently. One feature of Bitcoin has been the tight liquidity structure of the market. A lot of the original owners of Bitcoin, quite sizable ones,
Mhm.
were they hodled, they bought and hold. Just like if you bought and held, just like if you go back to the Japanese stock market years, decades before, when I first started looking at the Japanese market in the 80s, and I couldn't understand why the PEs are so high. It's like 60 times earnings or whatever. And you realize after a certain while, the cross holding nature between the companies, the Keiretsu, the Zaibatsu. So, in other words, if I want to go buy, Curia Financial, and it says it has a $10 billion market cap, well, there really isn't $10 billion for sale. The free float's only like 500 million or a billion. So relatively small moves, small.
Yeah.
Okay, we'll push up and down.
Few
And
things.
I think with Bitcoin, that illiquidity, we talked about IPOs before. The illiquidity served it well. But now what you're seeing for the first time in recent weeks, I don't know if it's sustainable. And again, there are people out there who've forgotten much more about Bitcoin and wallets than I'll ever know. But it's been identified. There's been a fair number of large holders,
Mhm.
accounts have owned the Bitcoin for years and years and years. They're for the first time starting to sell.
Hmm.
So that will also influence the supply demand situation. So, we'll talk about predictions for
Yeah.
2026.
Yeah.
Crypto totally giving up the ghost is on my bingo card.
So it sounds like bottom line of Bitcoin, to you, there's really nothing special about it. You're not totally against the idea of having a bucket, an asset class, whether it's Bitcoin, whether it's gold, silver, beanie babies, baseball cards, where essentially it's just about price. You're not as far as Warren Buffett would be, who would say, I only want something where there's an economic cash flow stream, but you don't see any particular reason to buy Bitcoin when
No.
if you want risk, you can get that out in other
Well,
forms.
if I want to
If
serve,
you want a real solid thing, you get that in gold.
exactly.
Got it. Got it. Let me shift gears, and I'm going to try to bring up my phone, George, because I found something. Sam Rowe, who runs TKER.co, every year kind of collects the forecasts for the year ahead, S&P value. And this year, it's at the end of 2026, Bank of America says 7,100, SG 7,300, all the way up to 8,000 Deutsche Bank. Now, I myself have made fun of this because the forecasts are almost always wrong, but they're fun. And guess what? I'm talking about them right now. They make headlines. What's your view on this? Because we're entering 2026. Forecasts are all over the news. On a scale of like 1 through 10, how much stock do you give them?
Zero.
Zero.
Yeah. Well, maybe I don't want to sound like a wise guy, but
Not even like a 0.4 or something.
I mean, one of the best strategists in the street, in my opinion, is Michael Cantor. It's a Piper.
Mhm.
And some time ago, he stopped giving out index forecasts. Just as a waste of time. And in part because the market of stocks. I mean, look,
Yeah.
hey, look at this year. The market's up, S&P's up, whatever it is, 17%. The equal weighted's up less. But you sure as hell mattered whether or not you own precious metals or you own consumer discretionary. I mean, it's huge, or staples. There's a huge divergence, right? It's a market of stocks. I've learned, as tempting as it is, and I've done it probably every year my entire career to make forecasts, it's not terribly helpful. There's a famous quote from it was William Goldman. Nobody knows nothing. That's what I like to say. All right. It is a time of year where people make forecasts. So I have nothing particularly insightful to say about index levels, but I'll tell you what's
Mhm.
coloring my thoughts. And you bring up a really good triggered me to bring up a really good point, I think. It's not so much price, but it's the drivers. Like,
Mhm.
you know, we may say Tesla's overpriced, it's underpriced, but what's the driver? What like George, you may think it's going to go down, but what's the driver for that going to be?
Yeah.
Okay, because otherwise,
And right now, at least the cap weighted market is we've almost become like a big bet on AI.
correct.
Yeah.
So, but as I think about next year, things that are top of mind for me. So I look at the market. There's basically three buckets I put stocks into.
Mhm.
There's you just mentioned, the tech dominance,
Yep.
which is AI. They're in its own little orbit. Then you have the highly speculative stocks, the Oklos of the world,
Mhm.
the degen retail favorites. Then you have everything else. And everything else has been kind of, the S&P equal weight hasn't done a whole lot this year. So in terms of rather than making predictions, I think it's interesting to reverse engineer. And it's like, what's priced in or what's not priced in. Okay. So like the market is discounting higher earnings, no recession. Okay. Energy stocks.
Mm-hmm.
All right. We'll come to picks in a minute, but there's a group where they've been given up for dead. People are looking at supply demand forecasts and they're thinking they're going to have excess supply and intensifying glut in oil next year. So bad things are already baked in the price. The stocks are reasonably cheap. I mean, they're certainly cheap relative to the market. Are they cheap in an absolute sense vis-a-vis their history? Yeah. You look at speculation, look at the commitment of traders data in oil futures. The data is a little bit out of whack because of the government shutdown, but the last publicly available data showed us that the speculative interest in open interest in oil contracts was almost down to zero, and where the hedgers was almost up to flat. It's always the case in oil. You have oil companies that are always normally oil companies are selling oil, so they're the commercials. So you always have the commercials are short oil, all right. And by definition, if the commercials are short, somebody's got to be long. So you have the degen speculative long cut. Okay. So it's the normal state of events is the non-commercials are long, the commercials are short. But it's gotten so bad in terms of sentiment that the non-commercials almost have no net long position and the commercials almost have no net short position, right? You and I spoke about this, but I'm reminded from Mike Rothman, who's probably the most senior oil analyst in the street. He's explained to me over the years, and this stat just blows me away. The financial market for oil, paper oil, is 50 times the size of the physical oil demand. All right. So, we could be counting barrels and you may say, hey, George, there's 1% more barrels. But on the other hand, if all the hedge funds get bullish, they're going to take it to the moon. So coming back to like, what am I thinking about for next year? I think certainly it's not a consensus trade, although some wise guy at X said to me the other day, it's so non-consensus consensus. Okay. But I think there's a chance oil could go meaningfully higher. We talked earlier about bonds. I think there's a chance, it's not on people's bingo cards, a central case scenario that bond yields will go up. I think there's a chance that, I actually expect this one. I think that the commodity reflation story is going to continue. We're going to speak about drivers. The driver on that basically is the fiscal profligacy, the easy money from all the central banks. And I think they're just going to keep doing it until the market says no more. Bond market vigilantes, please call your office. All right. So we got rising oil prices, rising bond yields. I think commodities going up. I think there's chance for a sovereign bond market issue. You've seen, no doubt, Japanese bond yields are now at like levels they haven't. Some of the, depending on which tenor you look at, like the Japanese 20-year is, I don't know, I think it's up to 3% or some crazy number. JGBs have gone to the moon. All right,
Japanese
government bond prices down, yields up. Despite that, the yen continues to weaken. And you said, George, what's the relevance of that? When you have the world's biggest creditor country having their currency plummet and their risk-free rate going to the moon, that should give you pause. And by the way, we're talking before about the sustainability of the fiscal path, what's going on in the U.S. Japanese debt to GDP, I think is like 260% or some crazy number. It's like twice of ours. So if you want to imagine like how bad could it get, just go look over there. All right. And so, interest expense now is over $1 trillion, over $7 trillion in spending. So it's like, I don't know.
More than we spend on the military.
Yeah, okay. So it's like 15, 17%. Look in Japan, I think it's the biggest, it's insane. But anyway, so you may have you may have a real dislocation in sovereign bond markets. You may recall a few years ago, we had that so-called Liz Truss moment. This is a good example, actually, of what could happen, where the government promulgated their budget and the market immediately said, this is insanity. Forget that. Gilts just plummeted. All right. So imagine if one day we came in and for whatever reason, U.S. bond yields went up 20 or 30 bips in one go. And in turn, that set off a chain reaction on other financial asset prices. So I think it's a chain. And again, questions when, nobody knows. But I can tell you the temperature's getting higher. It's something we got to watch. And the last thing I'd say, so we talk about sovereign issues. are credit issues. We talked a little bit earlier about um, private equity and IPOs and whatever. One of the reasons to be more relatively sanguine about the economy right now is you look at credit spreads; they're very low. Those are always sort of the canary in the coal mine, or as some wise guy put on Twitter the other day, the owl in the coal mine, talking about blue owl with the
Yeah.
So I think a credit event is so far
A low credit spread, meaning the market is just too giddy, too positive.
yeah, and equities tend to surf in the wake of credit. So if credit's well behaved, unless you have a credit event and have a recession, you're not going to get in really that much trouble with equities. But watch credit, okay? So
Equity is a residual coin,
correct.
and it's designed to go up and down. It's whatever's left. A credit is a legal contract,
Correct,
with enforceable provisions. The buck stops with credit. In other words, in a way that doesn't stop with equity.
So those would be the things that I would look for next year, in terms of what I'm worried about. I'm always worried, but um, and so you want to buy tech right now. I think the market, at some point, maybe it's already begun to do so, will start to question the whole AI story. Not that AI, and no one's going to accuse me of being an expert in AI, but where is the return on investment?
Yep.
And, when you see things like, forget about what I think, but you look at Oracle, where, how you look at Oracle and sort of, Oracle, where, Larry Ellison came out, talk about trying to paint the tape. I mean, the stock was up like 30% after hours one day, a few months ago. Well, it's given back that AI boost and then some. Hey, it's lower now than it was. Okay. And so that's the market's way of saying, and by the way, the Oracle CDS have gone up a lot because they announced they had I wanted to borrow $38 billion, whatever the number was. So the market will tell you when this is a problem. In other words, if companies keep getting rewarded, my AI spends bigger than your AI. Okay. And as long as we're in that arms race, fine. But when companies stop being rewarded for increasingly spending, that's the incentive to kind of tone it down. And so I think there's a reasonable chance. And again, this is not banishing AI to the basement, but I'm just saying there's a time when I think the market will increasingly question the financial aspects of this whole thing. In other words, tech, it's become all tech all the time. I think that could kind of take a rest.
So to set the stage, George, for your ideas, it's a market of stocks, not just a stock market. And if you're even if you're not in the big AI names directly, if you're in a cap weighted index, which almost everybody is, you're heavily exposed to them. That's a risk. We've got kind of the broader credit risk to the economy. Now, more than normal, is probably a time when, I think, if I'm understanding correctly, you don't want to just pile into an index fund.
Nope.
Maybe you want to pick individual names. And so so the dispersion creates the opportunity, as you've said.
Yeah. So I'll tell you a great story from the 80s. I was one of those irresponsible momentum gunslingers investing heavily in the Japanese market in the 80s. And the Japanese market got up to the point where it represented 66%, 2/3 of the non-US stock market indices. Okay. Just like the US now, 70% of equity.
Yep.
So the thing was, if you weren't heavily invested in Japan, you had no shot. Because Hong Kong's 1% of the index and Japan 66%, whatever. I remember, I won't mention names, but I remember in particular, there was one friend of mine, fund manager, and he's like, well, we're double or triple weight Hong Kong. We're 2-3% in Hong Kong instead of 1. Meanwhile, it's got nothing in Japan, so it doesn't really matter. At any rate, Japanese banks got up to like 10 times book value, 100 times earnings, and in part fueled by this tight cross shareholding we're talking about. And it was a clearly different market. All money comes piling in, but there's not that much stock for sale. So what do you think was going to happen? Okay. So, but imagine you're competing against an index where 2/3 of it is in a market where it looks like crazy to you. And in that market, 30% of that market is Japanese banks on 10 times book and 100 times earnings. But here's the funny thing. Once the fever broke, it was the easiest thing in the world to beat that market for the next umpteen years. Why? all you had to do was like have almost nothing in Japan, certainly nothing in Japanese financials, just index everything else. And you look like a genius. Okay. We're having this conversation today when I don't want to say we're at the apex because who knows, it can keep going. I mean, say this is the top, but this is the pain that people are feeling. It's the domination of the indices. And, sometimes I like to say that sometimes the market makes you look smarter than you really are, and sometimes it makes you look dumber than you really
Well
are.
said.
And I recall 99, 2000. This is a great one. I'm sorry I tell so many stories, but in the tech bust in 99, 2000, so many. What is a bubble? A bubble, the best definition I ever heard of a bubble is something that causes people to change their behavior. It gets them to do things they wouldn't otherwise do. Oh, it's FOMO. I have to buy Bitcoin or whatever it is, right? So there were a fair number of established, highly regarded investment professionals who were made to look really stupid in 99, 2000. George Vanderheiden, who you've never heard of, who was the number 2 fund manager at Fidelity, unbelievable long-term record. He basically got taken off of his fund because he refused to buy tech. Chuck Clow, who is now in Boston running his own shop, he was a global strategist for Merrill Lynch. He basically was shown the door because he wouldn't buy tech. I recall a quote in February of 2000. I guess sometimes you can't unsee things. Someone wrote, "If it's not tech, it's Drek." All right, okay. And then the last thing I'll say on this point is I'll remind you that that bull market, that NASDAQ bull market, which, was NASDAQ 5,000, now we're 25,000. It basically put both Julian Robertson and Stan Druckenmiller out of business. I mean, if we had a Mount Rushmore for all-time investment greats, those two guys would be on it. And it's kind of funny. You watch Stan now, he talks about it. So yeah, I knew I shouldn't be doing it, but it was the sort of thing. It was like back, he missed tech, fourth quarter of 99. He's like, all right, I can't stand this at a good party. Piles in. And Stan does things with gusto. And blew up on him. But he says to this day, I knew when I was doing it, I shouldn't be doing this. And Julian Robertson, he basically had to shut down because he was short tech. All right. So here it is. Think about that for a second. About a bubble. You have two guys, one who was long, one who was short, and they both got blown up by the NASDAQ boom and bust.
That's a bubble.
Yeah, that's a bubble. So coming back to what we should do. So I think the question was about indices. Look, the tech has been unbelievable. It can, I'm not here to say tech story's over, not at all. I just question the valuations in some of these things. If tech stocks, if the SMH sold off 40%, does that really change anything? We go back to value versus price again.
Yeah.
And so I think a tech correction is something that one should be concerned about.
So you told me as you drove in, you got some energy ideas.
Yes.
For today. So totally outside of the tech space, presumably pretty safe from AI collapse when I say that. I'm guessing they're fairly cash generative businesses, again, outside at least less bubble risk than some of the others. So, and these are trades that some people at home may want to make. We're not giving official recommendations, to be clear. Do your homework, talk to an advisor, whatever you need to do. These are just starting point ideas. So with that disclaimer though, George, what's the first one you'd like to talk about?
I have to kind of cringe a little bit because part of my concern now, you just said it. Some of these companies try to position themselves as AI plays, like, Schlumberger, we'll start with that one. Okay. The big energy services company.
If you're a publicly traded company these days, you're almost required to somehow.
The bankers and lawyers are telling you,
AI,
you got to put AI
at least 5 mentions on every conference call. Yeah.
Exactly. We could discover oil more quickly because we got AI and blah, blah, blah. So Schlumberger, so I came with 3 ideas. I wouldn't get too invested in the idiosyncratic nature of these names. They're more representative of the fact that I like the sector. The sector is kind of beaten down, hasn't done a whole lot. I mentioned before how positioning is very bearish around the energy markets. So I think the downside is pretty limited. And, if lightning strikes, you could make a fair bit of money here. So the first one is Schlumberger, which everyone knows. Actually, because they call themselves SLB now. Whatever. Diversified Oilfield Services Company. They're number 1 in almost everything. great company. It's not, does it have the most torque to higher oil prices? Is it the cheapest? Do I have a variant perception on the company itself? Like, I know something you don't know. No, I just think that the stock's down a lot, starting to act a lot better. This will be a go-to name for bigger flows if they have to come into the market, which is another thing too. You know this, James, the whole size issue. We could come up with James early oil and gas, but if it's a $300 million market cap, it might be incredibly attractive compared to Noble Oil and Gas. But if Noble Oil and Gas, actually, there's a company, Noble Oil, is in the indices, people are going to buy that. All right. So I recommend Schlumberger as one. I mean, there are racier names I come up with, have more torque, have more debt. But
if you want your bread and butter,
yeah,
standard
Schlumberger would be it. And also, I point out to people, the oil service index, despite everything that's going on with the oil price, just recently hit an 8-month relative high. So the stocks are acting better. And it's one thing too that I try to do. I don't want to say price never matters, but if you think something is so good that it keeps going down or the relative strength is negative, I always try to integrate a technical assessment of the security along with the fundamental assessment. So Schlumberger is one idea. Another idea is Valaris, ticker symbol VAL. Valaris is big, is one of the biggest players in the offshore market.
Okay.
Offshore is, if you look at where a lot of additional production has to come from in the coming years, I think offshore is going to be an important.
Yeah, we've used up the easy to get to oil.
Correct,
We got to get it in weird ways.
A lot of this stuff's a long-term contract. There are guys that are more geared to the spot market, but I think it's a very well-run company. You're not going to get in trouble with this, and it's got enough beta to the oil price where I think you do really well with higher oil prices.
And that'd be a little spicier.
Yeah, exactly. And by the way,
a higher risk tolerance.
Oil service tends to have a much higher beta than the energy names themselves, simply because the pricing on their products goes up and down a lot more than the price of oil itself. And the last one, I picked the integrated energy company, Cenovus, ticker symbol CVE, CV Cat Victor Edward. It's one of the largest Canadian oil and gas companies. I picked this one because the growth profile is superior to a lot of other names, and they're also integrating a recent acquisition, Meg Energy, and so I think that's interesting. And chart looks pretty good. So I think energy itself, I'd be.
And how would you peg in terms of Cenovus, in terms of risk reward relative to Veritas and Schlumberger?
Cenovus is probably the safest. Followed by Schlumberger, followed by Valaris.
Got it.
I still think that precious metals and commodities are incredibly well this year. So I think gold's going a lot higher. But
so you're not against the gold investment?
Not at all. I still own all that stuff. But I'm like, so give me something new, something differentiated. I think energy kind of makes sense here. I mean, energy, I don't necessarily believe in these things, but you look at the ratio of gold to crude. Historically, it's averaged like 20 or 30. All right. Now it's at 70, I think, some crazy number. All right. And there's no law that says it has to follow, but oil energy is just too cheap relative to everything else. And there is no anything else without energy. So to me, it's a chicken way of trying to stay in the game still.
So Cenovus, Schlumberger, and Veritas, kind of a mild.
Valaris.
Oh, Valaris, I'm sorry. Medium and spicy.
Correct.
Depending on your risk tolerance. Gold, always a good bet, at least right now. Not always a good bet, at least right now a good bet, according to George Noble. That's a pretty good suite of investment ideas for someone to be looking at for 2026.
But back to your point about the indices, I think it'll handily outperform the market in 26. I think gold is up like 60% this year. Silver's up 100. Again, past performance, past is no guarantee of future results or whatever. The GDX, the gold mining ETF, is up 140%. All right. But again, forget about price. Let's just look underneath the hood. Look at the valuations on a lot of the mining stocks. Okay, they're not cheap the way they were a year ago, but compared to what people are willing to pay for other stocks, other industries, so I think that you'll do pretty well. In particular, one call I've been making for a while now, I was publicly ready last year. This whole 60-40 portfolio thing, where you said 40% in fixed income and bonds, I would take that bond allocation and replace that with gold. I think
the whole thing.
Talk to your financials.
Some piece of it at least.
Yeah. Okay. Because you think about what you're trying to hedge against right now. you're trying to hedge against debasement and reflation. Bonds are not diversifying.
No.
And so I think if you just did that and nothing else, that'll put you in good stead. And if you ask me, what am I really worried about? Okay, I'm worried about, as mentioned before, this reflation train continuing, rates possibly going up. Not so much the other one, which is recession, because I think they're just going to keep spending more and more money. It's like we've repealed the business cycle in this country. We're not allowed to have a recession anymore. So,
and there's a real risk. Is the risk to worry about in your portfolio is when the correlation of your supposedly diversified portfolio goes to 1, and it all tanks together. So
correct.
You're saying gold is the best.
Correct, and also a lot of companies. The market itself has become a lot more interest rate sensitive than it used to be, because the valuations, the PEs are much higher, and especially the compounders, as they call them, those guys, the more high value, so not just tech, but the ones outside of that, higher interest rates, long-term rates would really be a significant headwind for those stocks. So you're spot on.
So George, just to put you on the spot with a final question, imagine a young person, guy, girl, coming out of college, mid-20s, has a little bit of money to invest. What quick advice in a minute or two would you give to that young person entering today's market?
My gold.
All right, simple.
No, I think you got. I really think you should read a lot. In particular, read some of the old timers. All right. So one of my favorite books, Jesse Livermore, 1929, Reminiscence of a Stock Operator. Okay. And you read it, and it's like the names have changed, dates have changed, and okay, they're not looking at prices on their phone, but they're sitting in wirehouses, and it's the same thing. Human nature has not changed, and it's all about fear and greed and how those interact. So I'd read a lot. I'd read that book. I'd read Extraordinary Delusions and the Madness of Crowds. It chronicles a great bubble strat history. And again, there's really nothing new under the sun. It's just, it's when you're in the middle of it, though, it's hard to see it sometimes. And I would turn off CNBC. I would, if I was on X, I would follow.
Besides George Noble,
ignore me. But there are some smart people out there who are eating their own cooking, telling you what they think, and I'd follow them. And just try to learn from others, and don't make price. I mean, price ultimately, yeah, you want to earn decent returns. But what is the term they use, James, these days? Like, don't base everything off of resulting. Like, oh, okay, well, what are you talking about? I made money in Oklo.
Yeah.
What are you talking about, old man? Oh, yeah. No.
And therefore I'm a genius.
Yeah. It's the Dunning-Kruger effect, that whole thing. Okay?
Yep.
Don't, just because you had a good outcome doesn't mean that was the right way to do it.
There's a lot of luck in investing. And it's very easy to mistake skill for luck.
Oh, yeah. And so don't get stuck. I think this whole idea, going back to the democratization of financing we've been talking about, turning the whole thing into a giant video game where you can push a button on your Robinhood thing on a phone. That's not investing. That's speculating. That's gambling.
Yep. It's fun. So a young person, basically, don't pay attention to the news. Look for long-term, timeless principles. Follow some smart people on X, but basically look for the stuff that doesn't really change. It sounds like your advice.
Yeah.
Let me ask our Gen Z production assistant, Ivy, in the background. What do you think of that advice? Thumbs up, thumbs down, thumbs in the middle?
In the middle.
He's a tough judge.
Hey, listen.
Yeah.
I really like when I was young, I used to speak like crazy as well. I really admire that.
Yeah.
And it's good when the getting's good.
But what you're saying is hard to digest. Like, if I'm young, I want something exciting. I kind of don't want to hear that. I want to like hear what the next crypto thing is, right? Some cool thing. But that's why there's profit in what you're saying. Doing the boring thing is often the profitable.
Right. And so, they'll I've heard things like, I don't know any bonds, right? I've heard things like bonds are for boomers, bonds are boring, bonds are for old people. Okay, fine. But then even when you talk about like normal stocks, it's like, it's too boring. It's like, number go up, I can't make 50% in a month or whatever. I mean, this too shall pass, I guess is what I'm going to say. We're going through a phase right now.
There's really nothing new under the sun, even though there always seems to be. Eventually things come back around. So we'll end on that note, George. Great great conversation. You shared a lot. I learned a lot. I'm guessing those at home learned a lot. I will let slip that, maybe you'll have more to share to the world in some format, shape, or manner soon. If you're watching this after the debut, we'll have a link on the screen for that. You can give your email address, and whatever may come next, we'll be happy to let you know first. Thanks for watching. George, thanks for coming up here. Cold but beautiful day in the Hudson River Valley. Again, I've learned a lot. Pleasure to do this. Hopefully we can do this again sometime. So
Awesome.
thanks again, George. And thanks to you guys for watching us at home.